Hello, friends. Welcome back on this quick review of the Blue Lines, which we have been posting for 18 months now. And they have proven themselves as they have for last 10 years. On this blog, twitter.com/369forecast, you can see we have successfully concluded 1,498 posts regarding these levels. And so they are not new in game, and they are here for a while. And we are showing this over and over and over. You can see that. So you can join this if you like, and we're gonna post. We are posting this for Apple, Amazon, Tesla, Intel, AMD, Meta, Microsoft, and if you want a few more, we can. And then also we are interested in posting for the 3 futures market: ES, NQ, YM. So the model is same, and it dynamically shifts what has to happen based on the market volatility and the ranges, what's happening. We are detecting those, and we are auto plotting for the next day. And so what happens is when this day closes, as you can see, around, and it opens again at 4 in the morning, you see that stocks are open at London Open, and you have this already ready for you. So you can leverage these levels. So how to use these levels, we have discussed extensively on the video blog. We can also discuss that again quickly as a thank you and reminder. So there are 2 parts of this component which you need to extract. As we post this for this day, 1 day at a time, you need to track these levels on your side. If you are interested in trading Tesla only, just track those levels. If you're trading Amazon only, this is the chart of Amazon, you just track these only. So you don't have to worry about tracking 10 of them, or you can track all 10. So what that offers you in return of doing your hard work is what we call as a frequency relationship. And we have made a video. If you go and check that YouTube 369 channel, which you're watching right now, look for frequencies. There are a bunch of frequency videos there, and we went through months and months how it really works out. But to just give you a snapshot of that along with the blue lines, so let's say we find the frequencies. How do we find the frequencies first? Now these frequencies are going to give you the reversal levels. Blue lines are going to give you which direction you want to be trading. And then we also have to do is track the prior levels where they are going to come and gun the reversals. So there are natural reversal points, natural retest failure points, natural trade points to take. So for example, right here, market came down, bounced here, came down, right? Below this we say go short, above this go long. And they will manipulate things. And if there are a bunch of levels next to each other right here, they will go for those levels, as you can see. But they are trying to explore. They're trying to explore. So if the exploration targets are right here, it's like going to visit your neighbors and your friends from childhood, and they all are clustered together. You said, hey, I'm already here visiting this guy. Maybe I can just go and walk the next 100 feet away and maybe meet and say hi to those guys too. Or if you are visiting and do some sightseeing and you're tired, you say, hey, you know what, I'm going home. But you can say, you know what, we are already visiting this site has already been visited, right? We were excited to leave and came back home. Maybe we can just buy some dinner on the way. You don't have to cook anymore because everything is so by. Are you going to go and, if you're already tired, to go all the way down here, 50 miles away, 100 miles away to fetch your lunch? Probably not. You're already tired, right? So this is actually really happening in the market is buyers come in, they get exhausted. Sellers come in, they get exhausted, right? So this is a man-made science, but there's only so much a man can do, as you know, right? So that's all there is. So the universe is much more powerful. These are laws of nature, but you can see they're exhibiting a behavior of human nature in a picture format. So the whole story is, if I'm coming down into a level and I've traveled a long distance, I may not be venturing going down to the next level, as you can see here, because you're already exhausted. And there may be something in the back, we don't know. Let's see why it stopped here. But see, there was nothing there, right? There was a big hole. This whole thing was a hole. So it went there. It did not attempt to go here. Now, this is called a Charlie rejection for folks who have done level 1 course. This is called Charlie rejection point. You can't see Charlie here, but there's a Charlie sitting right here between the two. You went to the Charlie and got rejected right here. So there was no interest. There was no stop. There was no gas station between this stop to that stop. If you stop here, you go up. If you don't, your next stop is here, right? There's a big gap. So they may not wait that long to hit the restroom. They just need to stop on the side and go behind the bush. This is all logical. Market is all logical. So the question of why market stops here, you're exhausted. You get tired. You take rest. When you're resting, you're going sideways. Right? You're going to the restroom. You're freshening up. So freshening up in market is you're just going to get bored and take a nap. And then as you nap, new buyers and sellers will come. And when they are excited, you go with them. You wake up from the nap and you go with them. That is what is called the balance points, right? You travel from jumps to jumps, rest and jump, and rest and jump. If you're a truck driver, this is your track. That's what it is. Resting place to resting place to resting place to resting place. So what we are doing is, now going back to the real technology behind it, these are the market buyers and sellers being profiled. And we're creating the balance points and extensions. These green levels are when we forecast this one next day, green and lower becomes very exhaustive points. So these become your exhaustive points. Now, if your market opens here, close to the green, here market came all the way down and got exhausted. If market is close by to the green, let's find that, right? So this green level, now this is again went all the way, now there are two levels for a reason, not have to worry about it. All the way to then got exhausted. It had to travel a lot and got exhausted at the green level, right? And this is the end of the day, they don't have enough power to push it up. So then they were resting. See that? The market came down, got exhausted, and they went to the resting place. So that's one of the reasons you need to track those over time. They are going to these levels and resting. All right. They could have gone all the way down here, right here. They did not, because at the end of the day, people were already satisfied with their return. So they were sitting there, but they're sitting in the resting spots. Now you open the resting spot. Now what do you do? So you're going to explore above green here, below green here. They went to the other side. And then they came back to retest it, rejected, retested, rejected, right? But they came back to the resting place. Same thing, market opened here, came down to resting place and took off. Open here, they're staying on the top, so go long only, long only, long only. If you're going staying on the short, short only, short only, short only. It opened above this long only, let it come back long only. You got it? This is how you trade. Okay. And then again, these are for the stocks. You can trade stocks, you can buy options. But you have to track these jump levels first. All right, so green, so let's mark those. I'll just move it. green. So you can see the green, you can see this green. Now this is not to the pinpoint tick scenario. These are the levels, right? For options, you need vertical spreads, or options, you need levels. See this? So now when the green levels are very close by, sometimes they just, depends on the volatility. Is low, it will go to the first green. Volatility is very high, it will go to the second green. Further away it goes to the green, expect a huge pullback. Okay, so these two green levels are just telling us the ranges of pullbacks. That's all there is. Sometimes it just goes to the tick, but this is a range. Why? Because it's between the two greens. Now this range is too big. That's a different story, because the volatility was very high. They're expecting volatility to maintain its strength the next day, and volatilities don't stay volatile forever. All right, so where were we? We were in the green investigation, right? So green, green, green. I'm just showing you the greens, and there's no green here, but it went to the previous day's green range, right? This is again clustered green, 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 green. A lot of them on the left side, lots of strong cluster level green, because this was almost there. There's also some light green in the middle of it. Don't worry. So you can see that we are driving the business from these levels, long and short. Here it was long only, but then it flipped on the other side. So here's what happens, right? You know that you have to be taking shorts only and longs only. When the market opened here, it was 9:30. It was right in the middle. You don't know it's going to go here or here. Wherever it goes and retest, you go. The puts were active here. Same thing here. Market opened at 8 o'clock. And we don't know. We don't have the options open yet. So options open here. It comes back. It goes here first, take a small loss, and then you go calls. So you be prepared to flip as it flips. And obviously you can have your other indicators and whatnot, but I'm just showing you pure price behavior. What's going on? How the vibration happens. So now the obvious question is, can we say something why it went here, so I can start picking up the top and bottoms? But this is where the part 2 we discussed over the years is get your frequencies. We teach you in a lot more detail. There are like lots of frequencies, but the easy frequency, because we are posting this as a social service, that you have to just do one thing on your side if you're tracking this, is to track the interplay of these blue lines. And in 3 months time, you should be able to build those frequency ranges. Just give you an example. So let's say last 3 months I've been tracking this, and I will track these 3 frequencies. And let's say my height is, this is the first height I found, blue to blue. And let's say this is the second height I found, blue to blue. Now let's say this is what has been carried over, because frequencies will shift every 1 month or every 45 days. They will rotate the market, shift the frequency because of the volatility. So let's say last 3 months I've been tracking this, and I found these to be the 2 greatest heights. Now I can use it as a forecasting reversal points. And as we discussed also, that this can be placed in various conditions. So if I put it on, this is already plotted, so plot a frequency here. And now this is also coming down between the green levels. So what did it tell you? It tells you. So this is how we predicted 7-8 last 18 months, 7-8 big crashes in the market. Tell you market is going to go from here it goes. Why? Why? Because we're doing the measured moves, we're doing the frequencies, and we are doing the balance points, as you can see here. So it gives you an idea that if you want to play, if you're a 10 lot trader, so you can play with 2. Start 2, 3, right? And you won. So that is what it is designed to do. Now you put the same frequency on the bottom of this blue. What happens? It tells you where it is going precisely, right? Now, there it is. This is all it takes. We are plotting these levels for you on the blog I showed you. Eventually, probably we might be able to do this as a live YouTube videos where we talk about it 5 minutes for 10 stocks, but we'll see. Okay, all right, there we go. Right, you got it. Now this frequencies are the larger frequencies. You can also put on the top to bottom. Now this bottom, top. See this top, the bottom. Now all of a sudden you are the world's best forecaster, isn't it? All it took was completing the level 1 course. So put it here, boom. So this has been discussed extensively, and oopsie, and there's no reason you cannot take advantage of this. And then what else? We got this one too, right? So I wanted to conclude this year's blog posting, and from the bottom, higher frequencies, tops and bottoms, mid-size frequency can go low. So they are probability space. I just showed it to you. Now you have mastered the AWS right there in front of you. Now there are 4 frequencies you need to track for the last 3 months. But they come from these blue lines. You track those blue lines first. And my friends, Happy New Year and happy holidays, and the blog shall resume in few weeks. Thank you.